Debt doesn't usually explode all at once, it breaks in stages. First, borrowing costs rise, then refinancing becomes harder. Then the weakest balance sheets crack first. That's what debt pressure looks like. Over the past few years, global interest rates moved from near zero to restrictive levels. That shift changed everything. When rates are low, debt is easy to carry. Companies can roll it over. Governments can refinance it. Investors tolerate leverage. But when rates stay high, the math changes. Debt becomes heavier, and refinancing becomes the real test. This is where the phrase refinancing wall matters. A refinancing wall isn't just a concept, it's a schedule. Debt doesn't mature smoothly, it clusters. Large amounts of corporate and government debt often come due in the same windows because it was issued in the same low-rate era. When that debt has to be replaced at today's rates, interest costs can jump dramatically overnight. For companies, that often forces trade-offs. Do you cut hiring? Do you cut expansion plans? Do you raise prices? Or do you sell assets to reduce leverage? For governments, the trade-offs are political. Higher interest payments can crowd out spending. That can lead to higher taxes, reduced services, or larger deficits, which markets eventually punish with even higher borrowing costs. This is why refinancing stress can turn into a spiral. Higher rates increase interest costs. Higher interest costs raise perceived risk. Higher perceived risk pushes rates even higher. And at the edges, in weaker balance sheets, that spiral can move faster than policymakers can react. It describes the period when large amounts of debt mature and must be replaced at much higher interest rates. Even if the borrower hasn't become weaker, the cost of capital can still rise dramatically. That alone can compress cash flow, cut investment spending, or trigger layoffs. And when many borrowers hit maturity at the same time, the pressure becomes systemic. Now zoom out globally. Debt stress rarely hits everyone equally. It concentrates where three conditions overlap: high leverage, weak currency, and dependence on external financing. The first group at risk is often emerging markets with significant dollar-denominated debt. If the US dollar strengthens while global rates remain high, servicing dollar debt becomes more expensive in local currency terms. Governments then face a choice: raise domestic rates to defend the currency or accept depreciation and higher inflation. Neither option is painless. The second group at risk is heavily leveraged companies, especially those that borrowed cheaply during the low-rate era and now face refinancing at higher yields. Many businesses don't collapse because revenue disappears. They collapse because interest expense rises faster than cash flow, margins get squeezed, credit ratings get downgraded, and lenders become cautious. This creates a feedback loop. Once risk premiums rise, refinancing becomes even more expensive. The third pressure point is government debt. In higher rate environments, governments face higher interest costs on new borrowing. If debt levels are already elevated, interest payments can begin consuming more of the budget. That crowds out other spending, infrastructure, healthcare, defense, social programs. When budgets tighten, political pressure rises. And political pressure often leads to unstable policy responses. But debt pressure is not just about who borrows. It's also about who lends. When risk rises, lenders tighten standards. Banks reduce exposure, credit spreads widen, liquidity becomes more selective. This is how stress spreads through the system. Now the key question is, who breaks first? Historically, debt crises often start at the edges. Smaller economies with limited reserves, highly leveraged sectors with fragile cash flow, companies with large refinancing needs and little pricing power. But the trigger is rarely obvious. Sometimes it's a commodity price shock, sometimes it's a currency move, sometimes it's a political event that spooks investors. The real cause is fragility that was already present. A higher rate environment simply exposes it. So what should you watch? First, watch credit spreads. If corporate bond spreads begin rising sharply, markets are pricing higher default risk. Second, watch refinancing activity. If issuance slows while maturities approach, that's pressure. Third, watch currencies. Sharp depreciation often signals capital flight and difficulty refinancing externally. Fourth, watch reserve levels. Countries with declining reserves lose their ability to stabilize currencies during stress. Debt pressure is not a headline. It's a slow tightening mechanism. It compresses budgets. It changes corporate behavior. It shifts investor risk appetite. And it tends to break the weakest links first. The high-rate era isn't just about higher mortgage costs. It's about a global refinancing test. And the real question isn't whether debt becomes stressful. It's where the stress appears first and how far it spreads once it does.